Good morning and welcome this morning to Advanced Charting Techniques, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab, and I'm joined out there in the chat by my good friend, Mike Fairborn. Mike's a 20-plus year veteran in the financial markets. He's going to be there to help answer your questions. And welcome to all of you, whether you're joining us in the live version or the recorded version. It does not matter. We're glad to have you here either way. And participate in the conversation while you are here, if you wouldn't mind. If you're in the recorded version, leave a comment in the comment section. We'll respond to that. If you're here in the live version, you have the great opportunity to chat in and converse with my good friend, again, Michael Fairborn, helping out there in the chat. Keep him busy today with some questions. He knows his stuff, especially when it comes to technical analysis. So we're going to talk a little bit today about a technical indicator that combines two different time frames. And this came up, the reason I settled on this as our topic of conversation today is because I just finished up teaching an advanced options virtual workshop. And one of the questions that came up in our Q&A session was, what are some of the indicators that you use that indicate confluence or confirmation of trend? Now, I know it was an advanced options virtual workshop, but this question was more about the technical indicators that I was using to make a decision about choosing a particular strategy. So the question really was, how do I look for confirmation of signals across different time frames? That's what it kind of boiled down to. So I started thinking about that and came across a technical indicator that I think might help with that exact perspective. How do you combine the confluence of momentum indicators across a daily and a weekly time frame to give you some confidence, perhaps, that a trend or a trending signal is moving in a particular direction? And so we're going to take a look at that today. But before we do that, a couple of quick a couple of quick housekeeping items that we need to take care of. Remember that everything we talk about simply for illustrative and educational purposes only. It is not a recommendation of any particular security or strategy or technical analysis technique or chart pattern or anything else. Individual symbols that we look at, those are for illustrative and educational purposes only. Now, we're probably not going to talk about options in this discussion beyond what I just mentioned regarding that advanced options workshop. But remember that options carry a high level of risk. They're not suitable for all investors. Make sure you're aware of the characteristics and risks of standardized options before considering any option strategy. Now, there are a lot of different ways to look at the market, and the way that we're going to look at it today in technical analysis in general, those are simply two of the means of looking at the market: fundamental analysis, probability analysis, and so forth. All of those are theoretical. None of these are guarantees as to what's going to happen. Schwab doesn't recommend the use of technical analysis as a sole means of investment research. Now, we're going to be using the Thinkorswim desktop software platform today, specifically the paper money version of that platform. And it's a great learning environment. It is not, however, a guarantee of future success out there in the real world. Always remember that investing involves risk, including the loss of principal. So let's jump in, talk a little bit about where we are headed. We're going to talk about how to implement this technical tool. We're going to talk about the pros and cons of the tool. And we'll look at some examples along the way. So let's do this. I'm going to jump out to the Thinkorswim desktop software platform here. Keep Michael busy with your questions. Thank you for being a part of that discussion and conversing. And I want to take a look really quickly here at what's going on with the S&P 500, just to kind of give us a baseline. And the idea being that we've got an overall longer-term trend, and we've got a shorter-term, and maybe even an intermediate-term trend that are both moving in an upward direction. And oftentimes, we use some sort of technical indicator to give us an idea about maybe a divergence, right? So when price is moving higher and momentum is falling off, some of those technical indicators that maybe we've used or we do use, or maybe you use, might be looking for those divergences between price and the indicator. Some of those technical indicators, on the other hand, are primarily designed to look at divergences within different time frames. So you have different ways of evaluating divergences. one of the ways that we use technical indicators and trend movement is through the use of moving averages. So right now I've got kind of out of the box here, we've got a 1-day moving average. That's the price, right? And if I were to change this style of the chart to a line chart, this is essentially becomes a 1-day moving average. It is simply what is going on each day in that closing price and averaged by the last day, because that's what it's plotting. And if we were to change the time frame, and I'm just going to bring my Flask icon up here, and I'm going to type in SIMP, simple moving average, and we're going to put on a simple moving average versus a particular time frame. I'm going to do a 1-day moving average, which is price, versus a 5-day moving average, which is in this case what I'm putting on here is a simple moving average. I'm just going to choose a color so that I can kind of keep track of it. I'm going to use this purple color right here as that 5-day simple moving average. I'm going to make it a little bit larger in size so that I can see that simple moving average. Click on apply and OK. And this can give us some insight. So I'm building to the technical indicator that we're going to be looking at here in this particular case. So this would be the difference. This chart that we're seeing here would be the difference between a 1-day moving average, the price, and a 5-day moving average of the price. And objectively, we could really kind of take this and say, look, I know that when I have a circumstance where the 1-day moving average is moving faster than the 5-day moving average, that's a gain in momentum. And price has a likelihood of continuing to move in a particular direction. And when that changes, when I get the 1-day moving average moving from above to below, that may be an indication of short-term change as well, because what that's telling me is that the short term, in this case, 1 day, that short-term momentum is weakening versus the longer-term momentum. And that may be a trend change indication, or at least a slowdown indication. So to kind of highlight this in terms of thinking about this process, if this were the setup that we were looking at, two different moving averages, a 1-day moving average price and a 5-day moving average, our entry signal might be this, price moving from below to above, and our exit signal might be this, price moving from above to below. And that is, to be honest, kind of the basics of a moving average crossover system, regardless of what the dispersion is in their time frames on those two different moving averages. We can make it much faster, we can make it much slower, right? It doesn't matter. We can choose whatever time frame in which we want to be able to do this, but the concept remains the same. When the fast moving average is moving faster than the slower moving average, that gives us an indication that there is bullish momentum. When the fast moving average is moving below the slower moving average, that gives us an indication that maybe there is bearish momentum. And from that, we can take those entry and exit signals. Well, then we start to kind of think about this a little bit. We start to think, okay, maybe there's some additional information that we can glean from this relationship. We can say, all right, when there is a greater dispersion between that fast moving average and the slow moving average, meaning when there's a greater range in between those two, you can see that kind of plotted here. And we can see that here on the price versus that fast moving average. Maybe what we could do is for each one of those plots, we could just plot the difference of those two ranges, right? And we could say, all right, we could build this kind of histogram when they're getting closer to one another. Oh, and by the way, if we were to just adjust that a little bit, let's kind of adjust that. We could say, all right, let's draw a zero line. And when this difference between the fast moving average and the slow moving average is positive, when it's a positive difference, put a line there. And when it's a larger positive difference, put a bigger line. When it's a smaller positive divergence between those two, put a smaller line. And then when it goes the other direction, like it did right here, then put a line below and maybe even make it a different color if you wanted to, right? And then when that grows to a larger difference between those two, make that a larger line, and then another line, and then wherever that plots. And then We could say, all right, when this moves back up again, then plot that difference and make it large, make the line larger or smaller. You can see what we've just created, right? We've just created essentially the circumstances of a MACD histogram, a moving average convergence divergence histogram. I've just given you some insight into how that particular indicator is calculated. Or some slight insight. Oh, by the way, speaking of slight insight, a couple of things. We would love your insight into how to make these webcasts better, how to make this session better specifically. If you would click on that feedback link there, on that survey link that Mike has reposted in the chat, he's going to pin it to the top of the chat as well. That's going to help us to make these sessions better. It takes a couple of minutes. And that's all we ask of you, really, is to fill out that feedback survey. So what I would actually ask you to do right now is click on that link, open up that page that pops up, and then just set it aside. And then when we're done with the webcast, come back and fill it out. Otherwise, you run the risk of maybe not being able to fill that out and not being able to get your voice heard in this conversation. So we've essentially created somewhat of a MACD, a bit of a rude or maybe crude characteristic of a MACD. Now, there are some other things that the MACD, moving average convergence divergence indicator, does that we did not do in the construction of this, our kind of own technical histogram-based indicator here. In fact, what happens in the MACD, in the moving average convergence divergence, is the indicator takes two different moving averages and then compares that average, takes the difference between those two and compares that to the average of that difference. So it tends to smooth out some of the disparities in the data. Because what would tend to happen to this type of moving average indicator, if we were to just leave it like this and just look at raw moving average data in that comparison, then what ends up happening is you would realistically end up having, depending on the length of those indicators, these whipsaws where the difference kind of gives you this whipsaw in and out. And you can see that relationship here, especially in non-trending markets. So the mechanism that helps the MACD, or the moving average MACD, moving average convergence divergence, the mechanism that helps the MACD become an effective and useful tool is that smoothing effect of the difference between the two moving averages and then its average. So it is a smoothed indicator. So that means smooth equals lag. A smoothed indicator equals a lagging indicator, because the smoothing impact takes out some of the more rapid signals. Okay, that's fair. And unless we are frenetic short-term traders, that's probably not such a bad thing, because we're typically, as trend traders, not trying to scalp those individual minute by minute or tick by tick types of moves, because those whipsaws, especially in non-trending markets, could be devastating in terms of trading impact, in terms of transaction costs and all of the slippage and all of those other things, right? So a smoothed indicator probably, perhaps, and again, I'm not making a recommendation in this case, but a smoothed indicator lags and filters some of the noise from the signal. And you're right, Paul. Yeah, every indicator lags. Every indicator mathematically lags besides price, right? Price lags behind decision making, but price is probably the fastest indication. Okay, now we know that. And I just wanted to kind of set the table here. Now, I will say this. If you are brand new to technical analysis, I'm just going to remind you the title of this particular webcast, which is Advanced Charting Techniques. And bear in mind, it has the word advanced in the title. So if you're just getting started with the discussion of technical analysis, we've got some great resources for you. This is going to be a little bit deeper, wonkier dive into some context around technical indicators. So they asked a great question: what are leading indicators? Well, there are indicators out there, economic indicators and other that use this name, leading indicators, and they may be precursors to other types of economic data. But when you talk about leading indicators when it comes to price action, there really isn't a leading indicator that can tell us in advance what's going to happen over the horizon in price action. There just isn't, because news happens, right? Who knew? I said this morning. Who knew that the news was going to come out that Chuck Mangione, Hulk Hogan, and Ozzy Osbourne were going to die in the same week? Who knew? Who had that on their bingo card, right? That news was not known. But that's why there's really not an effective leading indicator in terms of being pre-price movement. So one of the ways that we can confirm price movement or confirm momentum is by comparing, just like the MACD does, comparing two different time frames. So that's one of the reasons why some traders will use a longer term moving average and a shorter term moving average. Or some traders will use, I'm going to just do a couple of things here real quick. Some traders will use, I'm going to save this grid for just a moment. I'm going to save this as my single grid, and I'll come back and resave it again. But some traders might use something like, I'll give you an example of a grid that I use when I am on the Schwab Network. By the way, Schwab Network brought to you by our media production company, Charles Schwab Media Production, which is a separate affiliated company. But if I'm on the Schwab Network, I might use a combination of two different time frames. This is a yearly chart, and then I might go to a 5-day, 5-minute chart and compare those two different chart time frames. And as I look at those two different time frames, one gives me confirmation of the other. As I notice on the longer term chart that Lululemon in this particular case is breaking down below that moving average or that support level that I've drawn in. And then I look at a different time frame and I can see that this trend in the shorter term time frame is down. That's disparity of time frame confirmation of that price momentum or that price movement. But in the shorter term, I can also see that I've got a little bit of a bullish divergence in the RSI. So going back to the original question, well, how do we confirm what's going on? How do we get some confirmation or collusion, if you will, between moving different types of technical indicators? Well, that's where I came across this particular technical indicator. So I'm going to come back down to my single grid, which is, again, my playground here. And I'm going to go back up to my Flask icon. I'm going to take these off that we have created, that simple moving average that we put on there. And I'm going to click apply and OK. And I'm going to change this back to my typical candle style. Now we've got candlesticks again. And I've got a couple of different perspectives. So one of the technical indicators that we just talked about is that moving average convergence divergence. And the moving average convergence divergence that we are most kind of frequently familiar with is this one right here. MACD, MACD. And if we were to just put the MACD on here, I'm going to put that MACD on here. I'm going to show that particular tool. And there it is right there. You've got the fast and slow moving average difference. You've got the average of that difference. And then you've got that histogram. And you can kind of see what that histogram is doing, plotting those lines relative to what we were just talking about in terms of where that buildup of momentum was, or where that pullback in momentum was. So that's the MACD, as typically most people apply it. And if you notice, this particular MACD uses a 12 period. Now, these are daily charts. So this is a 12-day and a 26-day moving average. And it gives us a daily representation. Now, we're going to call this length of moving average convergence divergence, or MACD, a daily MACD. Now, in each trading week, there are 5 days. So what if we took this daily MACD and we went back up here and we added another one, MACD, and let's add the MACD again, and we changed the time frame by going to the gear icon, and we times these by 5 so that we incorporate a week's worth of movement as opposed to just 1 day's worth of movement, 5 days in a trading day. So if we take this fast length and we times that by 5, that's 60. And we take this slow length and we times that by 5, that's 130, right? We're going to leave the MACD length the same. We're not going to change that average here. And we're going to just click on OK and apply and OK. And now we get this MACD down here that is more of a weekly MACD. That's more of a weekly MACD. And you notice what that's doing is that's smoothing out kind of that whipsaw period here. And it's saying, look, if we take that weekly data, we're getting more of a smoothed effect. It's got some solid momentum to the upside. Now, this is where we run into a risk of the possibility of over analyzing. We can kind of start to emphasize what's going on in the MACD and what's going on the longer term MACD and de-emphasizing what's happening with price. Remember, price is always primary. Price is kind of always our primary input here. But what this tells me is that if this is the daily, let me grab my magic marker. If this is our daily, AILY, daily MACD, and this is our weekly MACD, the daily momentum is kind of sideways, but the weekly momentum is up. And so when I get a breakout of that range, that might be an indication that the daily moving average, the daily momentum is increasing and the weekly momentum is increasing. And that might be an entry signal. So when we start to see this crossing over and breaking out, or we get an entry signal on that daily MACD, that might give us an indication that we've got a confirmed bullish move going on. Okay, cool. Now that we have that whole idea in mind, what if we were to combine that? What if we were to kind of mash these two up a little bit? What if we were to mash up the daily and the weekly MACDs, and we were to use that as an indication of maybe some entry signals when there is that confluence and exit signals when they start to disperse from one another? I wonder if somebody's ever done that before. So I'm going to delete this. And I say that rhetorically, and you know I'm saying that rhetorically because I was being a little bit sarcastic about that. But I'm going to go to my Flask icon. I'm going to hide these two that I've already put in here. I'm going to type in over here MACD, MACD, and I noticed, oh, look, somebody has already created an indicator called the weekly and daily MACD. And if I go to the little question mark ID, I can see that the weekly and daily MACD is a study developed by Vitaly Aprinin for analysis of the moving average convergence divergence oscillator using 2 time frames on a single chart. That's exactly what I was trying to get to. He's already done it. That's awesome. So I've already got that combination built. So you know what? I already put it on this chart. I'm just going to click right here, and I've got the weekly and daily MACD on this chart. So I'm going to open up the eyeball for that weekly and daily MACD view, and I'm going to click on apply and OK. Now, it doesn't have the histogram, which is fine. I'm OK with that because that histogram disparity in this case is maybe not as effective and not as important to me as the information that I'm getting right here. So what I'm going to do, let's go back to that Flask icon for just a moment. And let's break this down by clicking on the gear icon. Now, the first thing I'm going to come in here and do is change the line weight settings so that I can see those line weights a little bit more clearly. I'm going to change those all to 4, and I'm going to click on OK and apply. And now those lines are a little bit heavier. It makes it a little bit easier to see. So now I'm going to come back to the gear icon, and we can see, look, here's our weekly time frame of our MACD, and here's our daily time frame of our MACD, and our daily time frame is 12 and 26, and our weekly is 60 and 30, which is 5 times 12 and 5 times 26, and that gets us to that range we just did with our using 5 times the daily information. And so now what we're seeing is 3 different plots. A weekly MACD, that's the red line. Let's grab this one. Daily MACD, that's the tan colored line there. And a weekly and daily MACD, the sum of those, the combination of those two, and that's our blue line in this particular case. So what this is doing is it's essentially creating a MACD using a weekly number and a daily number as the 2 signals, and then it gives us a daily number as a comparison or kind of a confirmation. Now, by default, that daily MACD doesn't show, and all you see is these 2 lines, the blue and the red line. But what we're going to do is we're going to come in here and we're going to turn on. So I'm going to go to that gear icon one more time. We're going to turn on that daily MACD line, the tan line here, so that we can see that additional confirmation. So I'm going to click on OK. We're going to click on Apply and OK. So now, just kind of keeping in mind what this relationship is, I want to just show you what each one of these lines represents. So I'm going to come back over here to my Flask icon, and I'm going to turn the eyeballs on each one of these. So my weekly MACD line, 5 times the daily, is 6130. I'm going to turn that on, and if we click on Apply, you can see what that line looks like. That's the red line here on the combined indicator on that weekly and daily. That's the red line. Now, if I were to turn on my regular MACD, turn on that eyeball and click on Apply, that's the daily line. So this blue line is the sum of those 2. Much like in the regular MACD, we've got the 12, 26, and 9. So I'm going to turn the eyeballs off on those 2. Now that you know what those refer to, and click on OK. And here we have our technical indicator. Now, what this tells me in terms of practical use is I've got a weekly MACD that's moving higher. I've got a daily MACD that's moving sideways, and momentum is diverging a little bit. So nevertheless, I might have this breakout of price, but overall in the shorter term, momentum is starting to wane somewhat. So in terms of taking a breakout or looking for an entry into the trade, I might wait until perhaps that daily MACD indicator was starting to confirm the direction of the sum of those 2. Let's look at a different indication. So we might use, as far as entry signals into this type of system, the cross of that blue line, the sum above the weekly, with confirmation coming from the daily line. So that would give us an entry signal maybe right about here. Now, is that going to be the fastest entry signal into a swing trade or to an intraday trade? No. But is that going to give us a confirmed entry signal into a longer term trend trade? Perhaps. Because let's just kind of correlate this to what else we know about technical analysis. What did we have in this time frame? We had a skewed double bottom, and that entry signal basically comes on the breakout of that price pattern above a resistance level. It doesn't always happen that way, but it nicely lined up there. So if you're looking at a way to kind of confirm what you're seeing on a technical price pattern on longer, intermediate to longer term time frame, this weekly and daily MACD may be a complementary tool to being able to help you make a decision. Now, this is the SPX. I talk about the SPX in my weekly trading index options webcast, but we're not going to do that here because we can't trade the index itself. So I went over here to my Market Watch tab, and I opened up my watch list that's titled Scan Query Bull Flags. Now, Kevin Horner teaches the price pattern webcast. Don't give me no and perhaps, give me yes and confirmed. Gosh, I wish I could do that. So I'm pulling up this particular list. And so what I'm looking for in this list, this is simply a dynamic watch list that the results are based on the results of, sorry, I've got to jump, my light's falling off of my camera there. There we go. The results of this particular watch list are based on a breakout, a pullback, and then a breakout of price. So I can sort this a couple of different ways. I can sort this via breakout. I can sort it via close above the high of the low day. I'm going to use breakouts as kind of that filter here. Now, if you've been in my bull flag class, I'll even do this. I'll be fair and share the characteristics of this scan with you because I'm a nice guy. Let's open up this scan here really quickly. Let's load our scan query. I'm going to open it up. It's in my personal, and let's go to bull flags, and I will share this with you. And I'll share that scan query. Now, remember, anytime we share anything, anytime we share anything, that is for illustrative and educational purposes only. It is not any kind of a recommendation. It is not guaranteed as to time or accuracy or anything else, but I'll just share that with you. I'll also put it in the description page for this particular webcast. But all I'm doing is I'm getting the stocks that have pulled back and are breaking out. That's it. That's all this search is designed to do. So the one that I'm going to take out of this list, just as I'm kind of scanning through here, is this one right here, Newmont Mining. It used to be Newmont Mining. It's Newmont Corp. And it's a little bit lower volatility at the moment, but we're going to pop over here to our chart and say, look, here's Newmont that's making that bullish move today, the day following their earnings announcement, which came yesterday. So what I'm seeing on this particular chart and what this tool is helping me to do is confirm the momentum behind this breakout. I've got a resistance level breakout. It broke out above this previous area where it touched. It broke out above this 52-week high. And now we get this gap up to the upside. So for some traders, it's that if this, then that. If price breaks out of resistance, then enter the trade. We're adding a different confirmation. So here's the confirmation that I'm getting from this weekly and daily MACD. Now, I'm not saying that this is the best indicator. I'm just saying this is a simple way, perhaps, to confirm a price pattern breakout given some momentum indicators. So notice what's happened. We've had this strong upturn in the combination of the daily and weekly MACD lines. That's giving me an indication that there's strong momentum to the upside. The other thing that's going on is I've got an uptrending. So this is number one. I've got number two, an uptrending weekly MACD line. So I've got longer term trend moving higher, longer term momentum moving higher. I've got the combination of short term and longer term momentum moving higher. That's number one. And then number three is the daily moving average convergence or MACD line. That's number three, also moving higher. So combine that, breakout. So this is our primary indicator right here. Primary indicator. I'm just going to star that. Primary indicator is the breakout of the resistance level. The confirmation is one, combination of two different lengths of moving average convergence divergence moving higher. The longer term trend is number two, moving higher. Number three is the daily trend of that moving average convergence divergence also moving higher. So three forms of confirmation in one indicator to confirm that breakout. Now, does that mean that this breakout is going to continue? Absolutely not. It never does. It never does confirm that. It never does guarantee that. It never does indicate that. But it suggests, from a technical analysis perspective, I'm going to take my glasses off because it's important enough to pay attention to. It suggests that there is increasing momentum. So a breakout with increasing momentum over two different time frames could be a more confident entry, but never a guarantee, but a more confident entry into a breakout than just simply looking at price breaking out by itself, or simply looking at price breaking out relative to something like an RSI over a single time frame. So we're combining these two technical indicators, to give us some confirmation of that or some confidence in that. Now, Kelly asks a great question. That's why we call them indicators and not guarantees. Yeah, you're absolutely right. They can indicate something, but they don't know what the news is and they can't anticipate the news. They have no idea that Ozzy, Hulk, and Chuck Mangione all died in the same week. Not that that has any bearing on the price of the stock, especially Newmont Mining, but at the same time, you know, who knows? Maybe it's just depressing the market. Maybe we need a little smooth jazz right now. I don't know, brother. Maybe we got to break out. All right. And then we get on the crazy train here. So that being said, this is an indicator that maybe we can use. So let's look at another couple of indicators, a couple of opportunities here. I'm going to clear my annotations and let's take a look at a couple of other examples. I'm going to go back to my Market Watch tab. Remember, I'm sorting this list by my breakout column, and I'm just looking for those breakouts. So we're going to come down here into these indicators where the price is breaking out, either has already broken out or it's continuing a breakout. I'm going to take one that's maybe breaking out today. And I just happen to notice this one that has passed its earnings announcement, and that's Avago or Broadcom. I'm going to click there. I'm going to go to the chart. And here is Broadcom breaking out of that price pattern here, breaking out of a resistance level. But notice what's going on. I wanted to show you the contraindication here because we have the combination of the two moving higher. We have the longer term moving higher, but what we do not have is the confirmation of the daily momentum yet. It has not yet turned higher. It is still making lower highs in this context. So yeah, we have the price breakout above a resistance level, and we have 1 and 2 confirming factors on this moving average convergence divergence weekly and daily indicator, but we do not have the third one. Now, S asks a great question. What type of trading conditions do these indicators work best in? And much like any other oscillating indicator, or much like any other trending indicator like this, like the moving average convergence divergence, this indicator works best in a trending time frame when the stock is already in a trend, as opposed to a breakout of a range or a reversal type situation. The signal is going to be, as we see here, that signal is going to be relatively late, but it will still be a confirmation, even if that signal is late. So what we might be waiting for here in this particular circumstance is that daily indicator to be turning higher. Let's look at a couple of other examples here, and we'll also look for potentially an exit signal. So let's pop back over here. Let's go back to our Market Watch tab. And we know that we're our breakouts, and we're starting to see more breakouts at the moment. So what it appears to me is that perhaps this market is starting to pick up some steam here. Let's take this one, which is Norfolk Southern. I know that there's some news out about Norfolk Southern. And what I happen to notice is, again, this is where maybe we've got a little bit more confirmation. And again, we've got an earnings announcement ahead next week. But we've got to bounce up off of a level of support. It's actually breaking above a resistance, even though it went up and down yesterday. It's still breaking above that resistance level. And we've got 1, 2, and 3 confirming indicators here. So given the fact that we've got a little bit of a bounce here, we've got a break out of that resistance level, I've got some confidence that this is moving higher. Now, the earnings announcement presents a news possibility that could bring the price of the stock lower, but I'm going to go ahead and put on entry into this trade right here, buy, and we're going to click on an order to buy. I'm going to put a note in here. This is a confirmed breakout with weekly and daily MACD so that I know what that's doing. I'm going to put that in my stocks group, and we're going to click on send, and we're going to fire that order off, and we'll see if we can get into that trade. I may have to bump this a little bit because it's starting to move up. So I'm going to bump that, and we'll go ahead and we'll click on send and fire that order off. And now we ended up at 282. All right. So there is that possibility. Now, if we were looking at this for an exit signal, if you were already in a trade, so what we might do is come back to that Market Watch tab, and let's look at something that maybe has been trending, but that it is not breaking out at the moment and has maybe been pulling back a little bit. Let's come back down in here. One that I know that broke out recently, but is now starting to see maybe a little bit of downward move is CCL, Carnival Cruise. And this is an indication of where we might see an exit signal. If we are quicker to get out of a trade than we are to get into a trade, meaning we're willing to get off the bus sooner than we are willing to get on the bus. For those of you that have been in the live workshop, you know what I'm talking about. Look at this crossover between the daily and the weekly. That might be our exit signal here. And if we were long this particular stock, that exit signal might be the crossover here with the combination starting to turn down. We might also wait for that longer term signal, which would be the combination of the two crossing below the weekly as an indication as well. So this might be an early exit signal that we're seeing right now, maybe perhaps slower exit signal, waiting a little bit more, if perhaps your time frame was a little bit longer, might come if you get that cross back from above to below on those two moving averages. So let's just kind of summarize. We've done a couple of different things. We've looked at how to build this combination of the two. We looked at the components of the two. So let me go back up here to the Flask icon. Now remember, this is the weekly and daily MACD. The way that we built this is we took the time frame of the typical moving average, 12 and 26. Now you can adjust that. Doesn't have to be 12 and 26. But we took that, we times it by 5 to get a weekly. We put those together. We're showing the weekly MACD, the daily MACD, and the combination of those two, and where that zero line is. And that's another way that we could use it as well as we dig a little deeper into it. You could use zero line crosses too. It's going to be a longer line symbol or signal than what we're looking at here. But that gives us a way to use this particular tool. And this is a native tool within the Thinkorswim desktop software platform and a way to do that. By the way, you've got a feedback survey in there. Do me a favor, fill out that feedback survey. Thanks for reminding me of that. Click on that subscribe button down at the bottom of the page so that you can find more information about the Trader Talks webcast channel. And I'm going to come back over here and I'm going to show you that Trader Talks webcast channel here for just a second. Some additional resources. One of those additional resources is right here at schwab.com/coaching. And if you go to the live webcasts, you can see the live schedule. But I wanted to show you something else really cool. If you go over here to the Trader Talks webcast channel, which many of you are familiar with, you can subscribe to it. That's what you're subscribing to when you click on that subscribe button. If you subscribe to this, you can set alerts. But I wanted to take you to an area where you're starting to see a lot more traction. We've got coaches and others that are building short videos. And I know you don't always have 45 minutes to sit in a webcast like this. So we've been building short videos. In fact, Brett Crowther has built just a bunch of these over the last few days. These short videos in our Trader Talks webcast page. We're building a playlist of these, but right now they live in that shorts section. And things like creating stock chart targets with technical analysis, 3 triangle patterns, price, volume, and volatility in one indicator, 3 points for identifying a trend change, market breadth, market sentiment indicator. All of these are great short videos. These are like 3 or 4 or 8 minutes long in some cases, and a great way to get little bite-sized chunks of information. I highly, I don't make a lot of recommendations, but I highly recommend that you check these out as well. And if you want to learn a little bit more about MACD, come over here to the regular webcast page, just click on home and type into the search box MACD. And you're going to see, here's Cameron May talking about the MACD indicator. Here's Barb Armstrong talking about MACD ATR. I know somebody had asked a question about ATR earlier. Mike Fairborn writing ThinkScript about the MACD, for crying out loud. I mean, what more could you want? Here's Mike Fairborn enhanced ThinkScript to spot multiple MACD setups. Cool. I like that. Lots of great tools, lots of great resources that you can use. Guys, thanks very much for joining me today in this discussion. I appreciate Mike's help with doing this. Remember, you can follow us on X at Ben Watson CS, at Mike Fairborn CS. Click on that feedback survey and fill that out. Great thanks to our production staff and our reviewers today, and great thanks to all of you. Have a great Friday. I'll be back at 3 o'clock Eastern time to talk market movers the end of the day. We'll see what's going on at the end of the day and what's over the horizon for next week. See you, everybody. Bye-bye.